London keeps repeating one number like it's armor: 844 million ounces of silver. But when a serious player demanded 1,000 tons, the market didn't act like it had an ocean of metal. It acted like it had a secret. And that secret is about delivery, not headlines. Let's talk about the number the London silver market keeps hiding behind like a bulletproof vest: 844 million ounces. That figure was circulated as the amount of silver sitting in LBMA-linked London vaults, metal that on paper makes the system look deep, liquid, and basically impossible to stress. 844 million ounces sounds like an ocean of supply. It sounds like, don't worry, there's plenty. It sounds like, whatever happens on COMEX, London is fine. But then something happened that should have ended the debate in a single day. A buyer came into the London market and effectively said, "I want 1,000 tons of silver." That is not a typo. 1,000 metric tons. In ounces, that's roughly 32 million ounces of metal. And here's the part that exposes the entire game. That single order, about 3.8% of the advertised 844 million ounces, didn't get filled smoothly. It didn't clear like a normal institutional trade. It didn't look like a market with almost 1 billion ounces ready to mobilize. It reportedly locked the market. Desks backed away, liquidity thinned, lease rates spiked. The whole machine started making that grinding sound you only hear when a system is operating on assumptions, not inventory. So we need to ask the obvious question. If London really has 844 million ounces of silver, how does a 32 million ounce request cause panic? Because it wasn't a big order. It was a reality check. And that's what this video is about. The moment the London silver market was forced to confront the difference between paper silver and deliverable silver, the difference between an accounting number and a bar you can actually move, allocate, and deliver on a deadline. Now, to understand why this matters, you need to understand what LBMA actually is. Most people hear LBMA and assume it's an exchange, like COMEX. It's not. It's a network, an over-the-counter clearing ecosystem where bullion banks, market makers, and large institutions trade metal through a mixture of spot, forwards, swaps, and leasing arrangements. And because it's OTC, it's not transparent in the way retail investors expect. The real plumbing is mostly invisible unless something breaks. London runs on trust, on netting, on rolling obligations forward. In normal times, that's efficient. In a physical shortage, it becomes dangerous. Because London's silver is not one thing, it's multiple layers. There's silver that is allocated, specific bars with serial numbers held for a specific owner. Unallocated, a claim on a pool, essentially a promise. Pledged to ETFs, tied up in financing deals. Leased out, swapped, or technically in a vault but not legally available for immediate delivery without someone else being displaced. And this is where the 844 million ounce headline becomes misleading. The number may represent metal in vaults, but it does not represent metal that is for sale. It does not represent metal that is unencumbered. It does not represent metal that can be delivered right now to satisfy a sudden large demand without blowing up other obligations. That's the first lie embedded in the 844 million comfort narrative. Because when a market is truly liquid, it doesn't freeze when someone wants 3 or 4% of inventory. If anything, it reprices, spreads widen, premiums rise, offers appear. The market clears at a higher price, but it still clears. A freeze is different. A freeze is what happens when sellers don't want a higher price. They want to avoid delivery. A freeze is what happens when the problem isn't price. The problem is metal. So let's define the problem clearly. London is being treated as the backstop of the global silver market. When New York looks like a casino, London is supposed to look like the vault. But if London can't mobilize metal on demand, if it has to pause when a single large request appears, then the backstop is not a backstop. It's a stage prop. And this is why that 1,000-ton event matters more than any headline price move, because price can be managed. Volatility can be suppressed, charts can be painted, but delivery is binary. Either the metal shows up or it doesn't. Now you might be thinking, hold on, 32 million ounces is enormous. Maybe it's normal that it's hard. No, not in the context of what they're claiming. Remember, the LBMA-linked vault number implies London is sitting on a pile so large that even major industrial demand should be absorbable. And we're not talking about retail coin buyers here. We're talking about the kind of players London exists for. Sovereigns, refiners, ETFs, industrial giants, central bank adjacent institutions. London is literally designed to handle size. So when size shows up and the response is effectively, "We need time," what you are seeing is not normal market friction. You are watching the moment a fractional reserve structure meets a request for reserves. And that leads directly to the core theme: paper versus physical. Paper silver is infinite because it's just contracts. Physical silver is finite because it's atoms. And the global bullion banking system has spent decades building a mechanism where the paper price can be influenced by leverage, liquidity, and derivatives, while physical tightness is masked through leasing and unallocated accounting. That mechanism works until too many people stop playing the paper game. And that is exactly what the world is starting to do as we move through late 2025 into early 2026. Industrial demand is not slowing down, solar is not slowing down, EVs are not slowing down, data centers are not slowing down, defense demand is not slowing down, and at the same time, the supply side is not elastic. Most silver is produced as a byproduct. It doesn't respond quickly to price. So the pressure builds quietly. And then it shows up in the plumbing. In things like sudden spikes in lease rates, the cost to borrow physical silver, backwardation and weird forward curves, widening spreads between spot and physical premiums, refiners stepping back, and desks becoming very reluctant to quote size in the OTC market. That's the kind of behavior you get when a system is trying to pretend it has inventory it cannot freely deliver. Let's pause on lease rates for a second, because this is one of those whisper indicators that tells you the truth before the headlines do. Lease rates are basically the price of immediacy for physical metal. If physical silver is abundant, borrowing it is cheap. If physical silver is scarce, borrowing it becomes expensive. When lease rates jump violently, it means one thing: someone needs physical now, and the market is scrambling to locate it. So if around the time of this 1,000-ton demand event, we see lease rates spike and liquidity disappear, that's not coincidence. That's the market admitting, without saying it out loud, that the so-called inventory is not truly floating supply. It's spoken for. Which brings us to the second lie inside the 844 million claim. Even if the metal exists in vaults, a large portion of it is not London's to sell. A big chunk is tied to ETFs, metal held for shares that retail and institutions believe are backed. Another chunk is held for private clients in allocated form, bars with legal ownership, not a communal pool. Another chunk is connected to financing structures where the same bar can be pledged, leased, and rehypothecated through multiple claims. And this is where the entire system becomes a confidence game. Because unallocated silver is essentially a credit instrument. If you hold unallocated, you don't hold a specific bar. You hold a promise from a bullion bank that says, "We owe you silver." That's fine, until you ask for the silver. Most of the time, people don't ask. They roll. They settle in cash. They net out. They trade exposures, not bars. That's how the paper market survives. But when a major buyer shows up and demands 1,000 tons, real, allocated, deliverable metal, it forces the market to convert paper convenience into physical reality. And the conversion is where the lie gets exposed. Because it's one thing to say, London has 844 million ounces in vaults. It's another thing to say London can deliver 32 million ounces promptly without disrupting anything else. Those are not the same statement. And the 1,000-ton order proved they are not the same market. Now, here's the uncomfortable part. The market freezing is not just about one order. It's about what that order implies. If one buyer can stress London with 32 million ounces, what happens when multiple buyers do it? What happens when industrial players decide they no longer trust rolling paper exposure and start insisting on physical buffer stock? What happens when governments and defense contractors start quietly prioritizing strategic metals? What happens when Asia starts paying up for physical and draining Western inventories through premiums, not spot price? What happens when the spot price becomes a theatrical number, while the real price is the one you pay to actually get bars delivered? because that split, paper spot versus physical reality, is the real danger signal. And it's already here. The public gets distracted by the dollar quote, 62, 64, 65, but professionals watch the spread between silver at $64 and silver you can actually source and receive. When that gap widens, it means the paper market is losing control of price discovery. And when price discovery shifts from paper to physical, the repricing is never gentle. Now, let's address the psychological trick the LBMA number plays on people. 844 million ounces sounds so large that your brain immediately categorizes any shortage talk as conspiracy. Come on, almost a billion ounces? But a vault total is not the same as available supply. Think about it like this. If a city has 844 million gallons of water in reservoirs, that sounds like plenty. But if 90% of it is already allocated to contracts, infrastructure limitations, legal obligations, then an emergency request can still break the system. Not because the water doesn't exist, but because the water is not free to move where it's needed, when it's needed. That's London. London is an inventory number sitting on top of a legal and contractual maze. And when the 1,000-ton request hit, the market didn't respond like a deep pool. It responded like a tight, overpromised system trying to avoid being forced into allocation. And that is why this is not just a silver story. This is a monetary story. Because the same structure exists across the entire financial world. Layers of claims on top of limited real assets. Treasuries, repos, derivatives, ETFs, unallocated bullion, fractional reserve banking. All of it functions until delivery or settlement becomes the priority instead of leverage. And once the world shifts from trusting paper promises to demanding physical settlement, the system doesn't gradually adjust. It snaps. So here's the problem definition, crystal clear. London's silver market is being marketed as physically robust. 844 million ounces in vaults. But when confronted with a serious physical demand event, 1,000 tons deliverable, it reportedly reacted with stress behavior consistent with a market that is heavily encumbered, heavily promised, and structurally dependent on rolling paper obligations instead of delivering metal. That is paper versus physical in one sentence. And that's why stackers need to stop obsessing over the paper price and start watching the physical signals. Because the real question isn't, what is silver trading at on a screen? The real question is, how much silver can the West actually deliver when someone with size demands it? And if the answer is not much, then the entire pricing mechanism is living on borrowed time. In part 2, we're going to walk through what this likely means about the true availability behind that 844 million ounce figure, how the LBMA structure makes a freeze almost inevitable under physical stress, and why this is setting up a delivery-driven repricing event as we move into early 2026, especially as global supply chains harden and strategic stockpiling accelerates. So let's connect the dots, because this is where the LBMA story stops being interesting and starts being a warning flare for everyone who still trusts the paper price. If a 1,000-ton request can make London hesitate, then London is not a physical market the way people think it is. It's a clearing narrative built on netting, rolling, and confidence. And confidence is fragile, especially when the world is relearning the oldest lesson in money. If you can't deliver it, you don't own it. Here's what I believe that 1,000-ton event really revealed. First, the 844 million ounces headline is not a lie because the ounces don't exist. It's a lie because it implies availability, it implies liquidity, it implies that London can meet physical demand at scale without stress. But in a market like this, what matters is not how much metal is somewhere in a vault. What matters is how much metal is available, unencumbered, and deliverable without forcing a chain reaction of settlement failures. And the moment you push London toward delivery, you push it toward the one thing the bullion banking system has tried to avoid for decades: allocation. Because allocation forces honesty, allocation forces segregation, allocation forces serial numbers, bar lists, ownership clarity, and most importantly, it forces someone to admit, this bar is yours and that bar is not. Unallocated is the opposite. Unallocated is the magic trick. Unallocated says, don't worry, you have exposure. And exposure is wonderful until the day you need the asset. Second, the market behavior tells you the real story. When a market is healthy, stress creates price movement. When a market is unhealthy, stress creates withdrawal. That's exactly what freezing looks like. It's not that nobody wants to sell at a higher price. It's that the system can't quote size without revealing. It doesn't have the metal to back the quote. And that is the tell. Because bullion banks do not fear volatility. They fear delivery. Volatility can be traded. Delivery must be fulfilled. And this is why you keep seeing the same pattern across silver. Paper price action gets chaotic, but physical tightness quietly intensifies. You see it in the premium spreads. You see it in the delivery delays. You see it in the borrowing costs. You see it when large orders suddenly become difficult, even though the inventory numbers look massive. Now zoom out. Late 2025 into early 2026 is not a normal demand environment for silver. Silver is no longer just a precious metal. It's an industrial strategic input tied to national policy, technology dominance, and supply chain security. Solar capacity expansion is accelerating. EV production is accelerating. Data centers and AI infrastructure are accelerating. Defense demand is not optional. And unlike consumer fads, industrial demand doesn't politely pause because a chart looks overbought. Industrial demand is planned years in advance. So when the physical market tightens, it doesn't relieve pressure. It amplifies pressure. It forces hoarding. It forces stockpiling. It forces pre-buying. And that is exactly how you turn tightness into a physical short squeeze. Now here's the part mainstream finance will not say out loud. The Western bullion system is structured to survive when most participants accept cash settlement, accept rolling contracts, and accept paper exposure as good enough. But the moment a critical mass decides, no, deliver it, the system is forced to reveal how much is fractional, how many claims exist per ounce, how much inventory is pledged, how many bars are effectively spoken for already. And that is why a 1,000-ton order matters. Because it wasn't just a demand event, it was a behavioral test. It tested whether London still functions as the world's physical clearinghouse, or whether it has become a paper hub that merely references physical inventory it can't mobilize. And based on what happened, the answer is clear. London is vulnerable. Which leads to the big question, what happens next? I think there are 3 phases, and we are already moving through them. Phase 1 is what you're seeing right now, instability and denial. Official inventory numbers remain comforting, public messaging stays calm. But behind the scenes, the market starts doing strange things that don't match the narrative. Lease rates spike, liquidity disappears at size, spreads widen, bars become hard to source at the quoted price. Refiners step back, desks quote smaller, timelines extend. And every time it happens, it trains the biggest players to do one thing: secure physical before someone else does. Phase 2 is the split becoming visible. This is where the paper price keeps trading, but physical begins trading in a different reality. Not in an obvious way like a second price ticker on CNBC. In a quiet way, premiums, availability, delivery terms. A dealer doesn't say silver is $90. They say we can't get size, and if you want it, the premium is brutal, and delivery is 8 weeks. That's a second price, a more honest price. And as that gap widens, paper becomes less trusted for price discovery. This is where backwardation becomes important. Backwardation isn't just a nerdy curve detail, it's a warning. It suggests immediate metal is valued more than future promises. In other words, the market starts pricing physical reality over paper time. Phase 3 is the event, the public trigger. The moment where the world stops arguing about whether paper is backed and starts asking, can it be delivered? That moment could take many forms. A major industrial buyer refuses cash settlement and demands metal. A sovereign entity begins quietly draining availability, and the market can't disguise it. A bullion bank fails to source metal for a short-term obligation and gets trapped in the open market. Or the LBMA faces a public delivery disruption that cannot be explained away as logistics. And when that moment hits, the paper price will not guide the move. The physical scramble will. Because in a true physical stress event, the price doesn't rise because traders get excited. The price rises because someone is forced to pay anything to locate metal. That's what a squeeze is. Now let's tie London back to New York, because this is where the global system becomes one machine. COMEX is the paper casino, London is the OTC clearing core, Shanghai is closer to the physical appetite. When physical tightness intensifies, you start seeing it leak into every node. COMEX registered inventory becomes more important because delivery becomes more important. Open interest becomes more dangerous because paper claims become more dangerous. Margin hikes become strategic because they're used as pressure valves to flush longs and reduce delivery threats. And what happens when these pressure valves stop working? That's when the cartel loses control, because suppression only works when physical availability exists to backstop the game. If physical silver is scarce, you can smash the paper price, but you can't deliver the metal at that smashed price. And then the only thing left is settlement games. Cash settlement, delayed settlement, force majeure language, alternative performance. Which is exactly why the LBMA's credibility matters. If London is no longer trusted as a physical clearing hub, then the global paper price loses its anchor. And once that anchor is gone, silver stops being priced like a commodity and starts being priced like a strategic asset with scarcity. That's the repricing. That's the moment paper holders discover they own exposure, not metal. So here's my verdict. The 844 million ounces number is being used as psychological warfare. It's meant to make you believe the market is deep. It's meant to make you believe physical shortage talk is exaggerated. But the 1,000-ton event exposed the structural weakness. The LBMA system is not built to handle a world that demands delivery. It's built to handle a world that accepts netting. And that world is ending. Because the clock is running toward early 2026. And the pressure is not easing. Supply chains are hardening. Export controls are increasing, strategic stockpiling is accelerating, industrial consumption is relentless, and the bullion banks can only play paper games as long as physical can be located when needed. So what should you do with this? First, stop watching silver like it's just a chart. Watch the plumbing, watch lease rates, watch physical premiums, watch delays, watch what happens when large buyers demand size. When the market pauses, that is information. Second, understand the timeline. If you're waiting for a clean, polite confirmation from mainstream media, you will get it after the move. That is always how this works. The repricing happens first. The narrative is written later. Third, make one mental shift. The paper price is not the price. It's a reference. The real price is what it costs to source and secure metal in size, on deadline, with no excuses. And when that real price starts detaching from the screen price, the endgame begins. Because you can manipulate a number, you can't manipulate physics, you can't print silver bars, and you can't negotiate with a production shortfall when technology and national security demand the metal regardless of price. The LBMA freeze wasn't a random market hiccup. It was the system coughing. And coughs become collapses when you keep forcing the system to pretend it's healthy. If a 32 million ounce request can expose stress in a market claiming 844 million ounces, then the real available supply is a fraction of the narrative. And that means the window is closing, not someday, now. Stay focused on the physical signals, not the paper theater. And remember, when the backstop reveals it can't deliver, the repricing isn't a prediction, it's a process, and it's already underway.